Hey friends, Sam Turgeon here with Sunlight Realty, and today I have the great pleasure of introducing you to Patrick Murtha. Patrick is a managing member at the Murtha & Murtha accounting firm in Wesley Chapel, Florida. They also do our business taxes and our personal returns. Patrick has a lot of experience in tax prep as well as in mergers and acquisitions, so a very good, knowledgeable resource. And today, Patrick, I wanted to just kind of tell you a little bit about a story that I experienced that I had this week. I had an investor call and he said, Sam, I've got about $4 million in cash and it's not like I can just keep it in a bank account with FDIC. So my opportunities right now is I can buy a negative yielding short-term treasury, or you can help me go find some property that's going to cash flow. And I thought it was very interesting. I never thought I'd see a day where people are being forced to deploy their capital just as a defensive measure. Never mind, usually you end up either going to cash or you end up going to treasuries, but those options seem to be off the table to a certain degree. So with that in mind, I've asked you here today to discuss two opportunities that we see for investors right now. One is the tried and true 1031 exchange. But the second thing is the economic opportunity zone, which took place, became effective in the last tax bill in 2017. So I'm hoping that maybe you can help shed some light on how investors might be able to utilize these different tax laws to not only preserve their wealth, but defer taxes. And I'm kind of interested to hear what you have to say about the economic opportunity zones and how they compare to the 1031 exchange. So if you wouldn't mind, just let us know what your thoughts are on those things.
Great. No, I'd be happy to. And first of all, thanks for having me on. I love opportunities to talk about, exciting stuff like 1031 exchanges and economic opportunity zones, which actually is really exciting stuff.
They really are.
If you have an opportunity, if you're in a position to utilize it. So first we'll talk about the 1031. As you said, it's tried and true. It's been around for a long time. Historically, you do a 1031. It's called a like-kind exchange. You could actually do it with any asset, but with the last few years, it was changed to where it can only be used for real estate. Mm-hmm. So right now, it's specific to real estate. And what it allows you to do is it allows you to take a capital gain that you have from the sale of a property, and you can reinvest the entire proceeds of that sale into a new property, a new piece of real estate. And what it allows you to do is defer that gain. So you don't have to pay tax on that gain now. You're essentially kicking the can down the road, meaning that one day you will, when you exit that investment, when you exit that real estate investment altogether and don't do a 1031 exchange, you will pay the capital gain at that time, but it allows you to earn a return on the IRS's money in the meantime. So it's a pretty cool tool.
Let me ask you a question, because we have an election that's coming up in November. And we're not really sure what the results of that are going to be. Would you suggest that maybe a client take advantage of the tax regime as it stands right now to potentially cash out of some of their assets, just in the event that the power swings the other way, we start seeing tax increases?
Well, yes, because, that's a good question. That's a case-by-case thing. That's a good question. It's my opinion that I think we're going to see higher tax rates in the future with everything that's going on here. Not what I came on the show to talk about, but you have this wild spending happening right now, and it was already wild before this, and then coronavirus hit. So how are we going to pay for all of the bailouts and things like that? It's the IRS. That R stands for revenue, because it's the revenue generation arm of the United States. That's where most of the money comes from. So I do think it's very likely. I think it's very possible that we're going to see higher tax rates in the future. We may see capital gains rates be increased. They've been kept at the same levels for as long as I can remember, but we may see that start to increase. Because right now if you look at history, we're at the lowest taxes we've ever been at in the history of America. Mm-hmm. So yes, I think it's very possible I might see higher tax rates. So we've been advising a lot of clients, if they're not in those higher brackets, to do, Roth type retirement investments so that their income can grow tax free and that kind of thing. This would, arguably be a case to, pay the tax now and take the hit before taxes increase, rather than doing a 1031. But the economic opportunity zone has benefits that actually kind of negate taxes altogether.
Yeah, please tell me more about that, because when I first heard about economic opportunity zones, I was like, this can't be true.
It sounds too good to be true. Yeah, I know. So basically, just to finish up on the 1031, eventually you're going to pay the tax, but you can defer it. And there's some rules that I guess we don't really need to get into, but it's complicated. If you have $1 million property that you're selling and you have a $500,000 mortgage on it, when you buy the next property, you have to invest at least $1 million into it. So if you sell the property, pay off the mortgage, you have $500,000 in your pocket, and let's say you have $100,000 capital gain. If you want to defer that full $100,000 capital gain, you have to go get a mortgage for $500,000, a new mortgage. So that may not be feasible depending on the property you're buying or depending on the lending environment. So it makes those 1031s pretty, things have to line up for a 1031 exchange to really work for you. Yes. And I have a lot of clients that, hey, I have a rental house that I'm selling, and I have a $30,000 capital gain and I want to do a 1031. Well, it might not make sense in that case because you're paying 15% capital gains tax, so you're talking about a pretty small tax bill, a few $1,000s. By the time you're done paying your attorney, your CPA, and everybody else that's helping you get that finished, you might not be saving any money. It may actually cost you money at that point. So
plus the aggravation of going through a 1031 exchange.
Correct. Yeah.
Not to be underestimated.
Exactly. There's a lot of hoops you have to jump through, et cetera. So the economic opportunity zone that the IRS did with the Tax Cuts and Jobs Act, essentially what it is it allows you to create what's called a qualified opportunity fund, a QOF. And with that, you're basically, you file a form and you tell the IRS, I'm setting up a qualified opportunity fund. And with that fund, you can only invest, essentially you can only invest 90% of your capital has to be invested in economic opportunity zone assets. So mostly real estate. There's some rules. There's quite a few rules that you have to follow. So if you're going to look into it, make sure you're hiring a CPA or an attorney that's going to make sure that you're investing in the right assets and that you're sourcing your capital the right way. Because there's some rules on what types of debt you can and cannot take, and there's rules on what types of properties you can and cannot buy. But as long as you're checking all those boxes, you can set up a QOF. Once you have this QOF, you can make purchases of assets that are, mostly real estate, that are within these economic opportunity zones, which are basically geographical areas that the government, would like to, and the government would like to elevate using capital. Generally, it's difficult to get capital in these areas, but the tax benefits can make it attractive to do so, to put money into these areas. So really, it's a good thing, not only for the investor that's putting money into it, it's a good thing socially because you're improving areas that are otherwise not seeing that capital influx. So it's a socially responsible way to invest as well.
So at a big picture level, basically an economic opportunity zone generally is an underserved area that the government is basically looking to try and have capital flow into. And the reason or the motive that they're giving, the incentive, is that they're going to have some pretty significant tax implications in the positive if they do make investments in those areas. And there are some time limitations and stuff like that. So if you can kind of just continue on with that, that's very interesting.
Yeah. So correct. So there's some pretty awesome tax advantages here. So there's tax deferral and there's tax avoidance altogether, which is really unlike the IRS to allow. So essentially the way it works is, you make the investment into the qualifying asset that's in an economic opportunity zone. As long as your investment stays in that asset. So what you're doing is you have a capital gain from another asset that you sold. Normally, you pay capital gain tax on it. What you do is you make an election in the year that you sell that asset that you're going to be essentially rolling it into this qualified opportunity fund. Once you have that qualified opportunity fund set up, you have 180 days, you have 6 months to get the asset invested into a qualifying asset that's in an economic opportunity zone. If you have that asset in there for a period of up to 10 years, then you get to, first of all, the gain is deferred immediately. Mm-hmm. If you keep the asset in there, I believe it's for 5 years, then 10% of the gain is actually forgiven. And then if you keep it in there for the full 10 years, then you can actually increase your basis to the full amount that you originally invested. And what that means in layman terms is you can erase your original capital gain altogether.
Does that include the capital gain that you would earn on the new asset as well, or is it just the original?
I believe currently it's just the basis.
Okay.
I believe currently it's just the basis. So essentially,
still, that's nothing to sneeze at. That's
right. Well, you could
amazing.
have you could have a cap. And here's the thing that blew my mind. So with a 1031 exchange, a traditional 1031 exchange, it's a like-kind exchange. So even before it was just real estate, you could use other assets like machinery and vehicles and things like that. It had to be, I'm trading my car in for another car. It had to be, I'm selling my, rental real estate and commercial for rental real estate and commercial or residential. It could be different types of real estate, but it had to be real estate.
Sure.
With the economic opportunity zone investment, you can sell your public stock and buy real estate in an economic opportunity zone and defer that capital gain. So it opens it up. It's just capital gain in general, because, and if you think about it, the purpose of it is really to spur investment in these, in these challenged areas. So they're kind of opening it up to any kind of capital gain. It doesn't have to be, the like kind is not part of this. And that's really awesome, because most people's capital gains in general are coming from equity in not just in real estate, but also in businesses and stock and things like that. So that's really the fascinating thing about this, is you can have somebody, you can have a high net worth person that sold their business and had a $2.5 million capital gain that then rolls that into a development in an EOZ, and 10 years later pays no capital gains tax on $2.5 million. Amazing. So it's a powerful tool for the right people. It's not necessarily for everybody. But it's definitely, and it goes so much deeper than what we're really going to be able to get to on the show as far as what the tax planning aspects can be. But I'll shed some light on one factoid is, let's say that you put your money into a multifamily housing complex and you're renting it out. As you can take depreciation every year on your property, right. On both the property that the building that you're renting, as well as improvements that you make. So if you buy air conditioning and put a new roof on, et cetera. Normally, and it is the case here as well, when you sell a property that has had depreciation, you're going to have to pay depreciation recapture. And that is still the case with the economic opportunity zone asset. So if you have a qualifying opportunity fund and you sell and you buy a building, rent it out for 10 years, and then sell it after the 10 years, you're going to have to pay recapture on that portion. However, if you sell the stake in the qualifying opportunity fund, then you don't have to worry about that recapture. So now you're going to have to find someone who's willing to buy your stock and the interest in your fund, and basically you're deferring that to them. But it's possible that you can literally have no capital gain at all, even on depreciation, which is really unusual. Yeah.
Well, they definitely are trying to incentivize investments into these areas. And I noticed that there is a map that's available, and the IRS has some information about that. It's an ESRI map. I can share it later on in the show description here. But the economic opportunity zones, as they understand them, are based on a census tract, which is the smallest governmental unit of land, from the big picture standpoint. And they base that based off of the economic impact that it would make into these zones. What's so interesting about it is we're in the Tampa Bay market, and Tampa itself down in, Tampa proper, as well as surrounding areas of Pasco and Polk and Pinellas, and all of these have different zones that are available. So if you have an investor that is looking to reallocate some funds, or what they're looking to do is they're trying to move from one asset class to another, this is one way for them really to take advantage and almost lever up, because all of your funds are working for you in the acquisition of the next property. So it's fascinating, and I know that for the average layman, this conversation is probably a little bit outside their norm. But if you're an investor or an aspiring investor, this is an opportunity that does not come all that often. This is a fairly new thing. It's just happened in the past few years. Very few people have gotten a good handle on it. but the implications are so vast for an investor that's shrewd, who does a little bit of planning. It's just such a tremendous asset opportunity. So as we finish up on that particular topic, is there anything else that you'd like to add about economic opportunity zones or 1031s, how they might differ and when you might use one versus the other?
Yeah, I mean, right. One of the biggest issues with a 1031, the biggest advantage of a 1031 of a qualifying, of an economic opportunity zone over a 1031 right now is, let's use an example where you have a person that has $1 million property that they sell, and let's say they had $500,000 of leverage, so they had a $500,000 loan from the bank, and they have a $100,000 capital gain, so they paid $900 for it with a $500,000 loan and sold it for $1 million.
Right.
So what's going to happen is at closing, they're going to get a check for $500,000 and the bank's going to get a check for $500,000. With a Section 1031 like-kind exchange, they have to buy another $1 million property, meaning that they have to go get debt in order to get the full benefit of kicking the can down that road and excluding that capital gain. One of the many benefits of the economic opportunity zone investment is that you are able to just take the 100,000 capital gain and invest just that. So in this example, so you can take $400,000 and put it in your brokerage account and, buy Tesla stock with it if you'd like, and take the remaining 100,000 from that capital gain and put it in your qualifying opportunity fund and just invest that and defer your full $100,000 capital gain that way. Wow. So it opens up the opportunity to diversify your capital from a big investment like that however you wish, as long as you're taking, and you can do it partial as well. You don't have to do the full gain. So, that's one of the things that struck me as a major difference from the 1031. I mean, the 1031 may be a good fit still, if it's not feasible for you to buy assets in an EOZ, but I mean, if you can find a way to do it in the EOZ, plus, I mean, from what I've seen, I haven't had many clients that have done this so far, but from what I've seen, it looks like it's not as complicated as the 1031, and the benefits are better. So
yeah, the 1031 is definitely, with all the timing issues and stuff like that, they can get very complicated if you have any hiccups in there. I mean, COVID is a great example of a hiccup.
Right. Yeah.
It's very difficult to navigate some of these larger transactions because oftentimes it requires a sale and a purchase simultaneously or within a very short period of time.
Right? Yeah.
So, it's unfortunately, timing is often outside the hands, outside of your hands. You can't really
absolutely. Yeah. So and that I mean, there's still a timing element to this, but there's not as many hoops, it doesn't seem like. So normally with a Section 1031, you have to have an attorney hold the money in escrow. You can't touch it. You have to identify the property in a certain period of time. You have to close on the property in a certain period of time. With the EOZ investment, it's really just a question of purchasing the property in that 6-month period, which is still, perhaps a challenge with COVID, but I would just implore anybody who's interested in looking into this to meet with their, tax professional or me if they don't have one, and really make sure that you're checking all the boxes and, doing it the right way. But it's definitely an extremely powerful tool. And, the thing I like most about it is you're helping, disadvantaged communities by doing it, because we're bringing it's the government it's a subsidy essentially, that also acts as a stimulus, and it's really, it's a really great thing. And I think we're going to see a lot of opportunities coming out of the pandemic, where there's going to be a lot of opportunities and probably more zones opening up. So
shifting into that, I'm kind of curious as to what you're seeing as a result of the COVID pandemic, both in your business and in the businesses, and kind of speculate on what you might think is coming our way.
Yeah, it's so hard to say at this point. I do a lot of reading, and half of what you read is somewhat optimistic, and half of what you read, it sounds like doomsday. I think here in Florida, I don't think we could be in a better place, honestly, is how I feel. I think it's an attractive place to live, and I think that there's a lot of expansion that's going to continue to happen here. A lot of we work with a tremendous amount of business clients, so I get to see a good slice of locally what's going on here. Some of my clients are doing okay, and they're a little bit slower, but they're confident things are going to come back. Some are doing just fine, and of course some are closed because they're restaurants, or they're in an industry that's heavily impacted by this. So far, people are adapting. They're, and that's really the secret, I think, to this crisis, or really any crisis, but especially a crisis of this magnitude, is you have to be dynamic, and you have to be, a ninja, and ready to, and ready to change.
Well put.
Yeah. And my success, the clients that have been most successful are the ones that are finding other ways to make money, and adapt to they're adapting, and the ones that are not are the ones that are throwing their hands up and closing their doors. Yeah. So that's really I think that's the secret right now.
Well, we've had conversations offline as well, but your thought process on where the commercial real estate market will be heading in the next 12 to 18 months, any ideas there?
I feel personally, and as we've been in the market locally for a commercial building for our office in Wesley Chapel. I think that I think office space, it's a supply and demand thing. I think that I've been reading a lot of research saying that the pandemic has forced a lot of workers to work from home, and a lot of them found, this is cheaper and this is more efficient, and we like this. So I think there's a lot of jobs that are going to permanently move to home, that otherwise wouldn't have. And I think that's going to limit, especially for traditional office space, I think that's going to limit, the desire there. So I think demand's going to go down, and obviously, when demand goes down and supply stays the same, price has to go down. So right. I anticipate, I'm not an expert in real estate, but my crude economic background would make me think that there would be a little bit of a price drop in the future here. And retail, that remains to be seen. If retail bounces back to where we were before, they might be okay. But if people are still afraid to go out and eat and go shopping, then that could be a little bit of a slow burn there too. But I especially think office space is going to be a little sketchy for a while.
Yeah, I tend to agree with that. Interestingly enough, I think that we have to segment that a little bit, just to say that, especially your main urban office space and your high density population centers, your sky rises, stuff like that, I think those are going to be the worst impacted because they're the highest priced. And of course, if they no longer have to do the commute, and businesses I always use the example of, if you're on Madison Avenue in New York City and you've got 50,000 square feet of space, but you can afford to do away with 40,000 of it, it's definitely a lot less expensive for the company. And then obviously people aren't wasting an hour or two in the commute. So I definitely agree with that. I think you're going to see a big drop there. But interestingly enough, the suburban office market is actually very strong right now. People coming out of the cities that still need a place to go to work are looking at executive office suites and stuff like that. And our building here in Zephyrhills, the Zephyrhills executive offices, in March, surprisingly enough, we leased out about an extra third of our building in 1 month, which is, wow. Yeah, I was just in shock. And the typical story, although it's a little anecdotal, is, I need a place to work. I love my wife. I love my kids. I love my dog, but I can't have all three of them screaming at me while I'm trying to operate. So, I totally understand that. And I think that you're going to see a big push toward that. Not so much the shared co-working space that we've seen in the past, where you're in the same room with 6 or 7 other people. You're still going to have a social distancing factor that's going to get involved. But I think we're in for some very interesting changes as a result of this. And we would definitely be interested in talking with you again in the future. And before we end today, I would like, if somebody would like to get a hold of you, how would they go about doing that?
Sure, absolutely. So our website is tampataxfirm.com. So that you can get all of our contact information there. Typically, right now with the COVID situation, we're doing a lot of video conferences via Zoom or via Google Meet. We're also doing a lot of phone calls. I think probably somewhere in the next few weeks here, we'll probably start opening up live meetings again. But yeah, definitely our website, and you can just give the office a call and schedule an appointment. And we have several CPAs and accountants on staff that are ready to help.
Beautiful. Patrick, we really appreciate your time today. Hopefully we'll talk to you again about another real estate topic in the future. And folks, if you have any questions about income tax or tax prep or planning, give Patrick a call. I think you'll be pretty well served with that. So
I appreciate it, Tim.
Thank you for your time. Greatly appreciate it. And we'll see you again soon.
All right. Take care.
Bye-bye.